Traders, how are you? Welcome back. Institutional Sunday. Something completely different for you today. Have a look at these charts, right? Name me anyone else who starts their YouTube video or trading video, YouTube, like this. No one, right? And what do we know? To make money in this market, you got to be different from the crowd. So maybe there's a lesson for you there, right? You know, all these videos starting off with, hey, I made money, you know, market structure, and I drew the line here, and then it came back there, and a perfect line, and hey, and then it just shot up, and yes, and yeah, okay, let's be honest, that ain't trading. That's just, I don't know what that is, make believe, right? So you're here in the right place, so well done, okay? So anyway, on to seriousness. Apologies for last week, lots of stuff going on. My gran passed away. I may not be around next week or the week after. So I had a few things going on. Managed to do this today. May not be here next week, but let's see. Also tons of webinars going on during the week, as you guys know. But anyway, what are we here for? We're here to talk about kind of what's been going on from an institutional perspective, a professional trader perspective. That's why you see all these wonderful looking volatility charts, and really that's been the theme in the last week. You can see here volatility has been spiking recently. We know that because of the impending fake Fed hikes. However, believe it or not, it's actually come off a little bit, right, in the last week, and that's what I wanted to highlight. This highlights this really well. You wouldn't believe it if you were actually trading the market last week. It was completely crazy. But actually it was less crazy. You know, the market's all about relativity, and relative to, you see this was the Fed week. You can see it really spiked during, obviously, coming into the announcement and so on, and during the collapses. But believe it or not, volatility came off a little bit last week, and that's one of the reasons why, and we're going to have a look at it in just a second. You'll see the market was actually very supported last week. Like, we had a really decent recovery. Recovery was the word I was looking for. You can see that here in my favorite chart, and I keep saying it, and I'm going to keep saying it, right? Because no one else says it, and as I said, to succeed in this game, you've got to be different. But essentially, you can see here, all the markets rallied. Okay, it wasn't just equities, all right? It was everything. If you're trading Bitcoin and you're not following all this stuff, you're just gambling, okay? You're not trading, because end of the day, the same stuff is driving everything that is driving equities, Forex, Bitcoin, yields. I mean, literally look at don't even take my word for it. Even if you think I'm completely crazy, it's irrelevant. We're here to deal in facts, right? I mean, that's what's going to get you further ahead. We know that. And the facts are there right in front of you. You can't erase that with an eraser, right? You got to accept it. That is what drives the market, right? They're all moving together. You can see them there. And particularly recently, we've seen that the massive surge up in Bitcoin and Forex and crude oil, and equities did lag a little bit, just for a variety of reasons. I think that was, which we can get into. Let's have a just quick overall look at what's been going on recently. Obviously, we had the sell-offs in January. That was the FOMC. Okay, we're well above now the FOMC day. We're not out of the woods yet, because even though people talk about FOMC days, I would consider that to be FOMC, because we did have a sell-off. And in fact, now that we're on about performance, just here, in fact, I completely forgot. I wanted to just mention, especially because I was away last week, people might be wondering, hey, Envy, have you been trading the market? I've actually had the best start I've ever had to a year. Not in terms of P&L, but just in terms of performance. Consistency, sorry, was the word I was looking for. So obviously had on a very good winning day streak. Obviously not particularly like 100% winning trades, of course not. You know, my win-loss ratio is still 72%. So that's not the highest it could be. So still plenty of losing trades, just in terms of daily consistency is very, very high. Some of that, surprisingly, is down to, a lot of people might be surprised with this, day trading is not about trading every day. Okay, you can see here 3 days in the first week of Jan traded, 3 days second week, 3 days third week, only 2 days the week of the FOMC, which I spoke about a lot, that I wouldn't be trading so much that week. That was the back end of the FOMC, if you remember. It was very volatile. We saw that on the first slide I brought up about the huge volatility in the Dow Jones, and then just coming into this week. I haven't updated it for Friday. Actually, I had a good day on Friday, which hasn't. But point is, 3 days, right, on average. You can see that. So people have this misconception of day trading, meaning you have to be in front of your screens all the time and all of that stuff. Obviously, there's the stats which you can kind of pause and look at your leisure. But yeah, so just coming back to it, as I said on the back end, this is the Dow Jones every single day. Point moves, okay? You can see that's why I took those days off around here, because the volatility was crazy, okay? And now it's coming off. The reason I mentioned this is really, really important, because I do a lot of research, obviously, to put all this stuff together, and I recommend everyone does. Don't just take my word for it. Obviously, if you're serious about this business, you know, and you're not just here just swinging and hoping, which is what most people do. If you want to be in the kind of elite crowd, and anyone can do it, obviously you just got to do some research, basically. And point is, when I was reading a lot of research, they were talking about this being down to Omicron not being as bad as the market feared, and that's why all these news outlets were struggling to realize why this rally happened, right? So we all know last week was very supportive, the market was supported. It's to do with volatility, okay? So like I said, you got to do your own research. Don't just take these news outlets' word for it. They don't trade, they don't have a clue. Sometimes they come up with some useful stuff, but apart from stating facts, the opinion should come from you based on your market experience. And that had nothing to do with the Omicron, because actually it contradicts the truth, right? If you actually just look at Omicron cases, they've gone completely wild. Going into January, you can see that here. This is daily cases per 100,000 population is completely bananas, right? In January, it's inverted, and we're going to talk a little bit about non-farm payrolls. Amazing institutional Sunday today. So contradictory to what everyone's saying as to why we had the rally early in the week. It's because the volatility calmed down, right? That is, in my opinion, you see the volatility calm down. It's been calming down a lot, and I think that provided, and that's why we had this big supportive move. I think it's calmed down people a little bit. When the market's very volatile, you'll see it's correlated to downside moves in everything, right? When the market calms down, you tend to see some relief rallies, and that's what it was. It was completely driven by volatility. Early in the week, I was buying the market for those reasons. We did actually end up about 1.5% up, but we're still down on the month. We were still up last week, but some of that was erased basically because of Thursday. Thursday was the only day we had a down day, but it was quite a big down day, and a lot of people were confused by this, you know, because the services report was quite positive. You can see that here. Can you see the services number? 59.9 versus 59.5. A lot of people, even some of my students, said, you know, the data is strong, don't understand. The reason is you have to understand that the market is prioritizing certain pieces of data, okay? So obviously the payrolls is going to be more important than the ISM services, for example. It's the first kind of look at how the situation was in January, but it's more than that, okay? It's to do with the fact that there was a lot of negative sentiment built into the forecasts for payrolls on Friday. So a lot of people obviously didn't realize this, but look at the forecast, 110K. And I believe if you look at the spread of forecasts, I think it was like minus 250 from all the investment banks that send their forecasts in. A lot of people don't know how this forecast is put together. Investment banks send their forecasts in to Reuters, Bloomberg, and then they remove the outliers, I think top or bottom few, and then they come up with a median, which is 110. The range though of forecast was, I think, minus 250k to, I don't know the upside, I don't remember off the top of my head, but I think it was plus 250k. So even the highest forecast, it smashed it, completely. It might have been about 300k. The highest submission, it completely smashed it out of the park. And the point is, the market was so expectant of a negative number. A lot of that is because of this here. So payrolls has been correlated, and it would be, right, with cases. Because what tends to happen when COVID goes up, what happens? People don't go to work, right? There's obviously issues with the jobs market when COVID cases tend to be high, and you can see it's fairly nicely correlated. You see the dip there, the dip there. So can you see it's been dipping recently? People expected the payrolls number to be quite negative, and the point is that is why the market was selling off so aggressively on Thursday. People, investors, you know, not people on Instagram or YouTube, serious investors that actually do this professionally, okay, they were positioning short. They were taking some risk off the table because the expectation was that the number would be fairly, not horrible, but fairly negative. In fact, we got the opposite. We got a very, very strong number, plus 467k. So it actually shot up, I think somewhere around here anyway. So the actual number came out strong. The unemployment rate was slightly higher, like 4%, I think, instead of 3.9, from 3.9 last. But the participation rate shot up, which the market liked, because this has been a problem recently. Obviously, people not wanting to go back to work, okay? But despite COVID cases and so on, labour market is very, very resilient. And people seem to be going back to work, probably attracted. If you look at average earnings, average hourly earnings have been very, very strong recently. So obviously people are being attracted back by what offers better pay, right? It makes sense that they would want to go back. We also had huge revisions to December. So December's number that came in, I think it was quite soft, that shot up as well if you look at the revisions. So anyway, you know, what does that mean for us going forward? Well, next week is quite interesting. We've got some inflation data, so I think the market will be focused on that. But I think what has really been interesting is the reaction to the payrolls number, because it could have gone both ways, right? If you think about it, obviously the market has taken the number well. As I mentioned, it was a strong number, but it isn't as straightforward as that. You know, we're in a different environment now. Obviously, the rate hiking cycle is coming, and you could argue that the payrolls number was so strong that it kind of suggests that there's even more chance that the Fed will be hiking. It gives them so much more kind of room to hike rates. So you could easily have seen the market sell off, because the market would have been feeling like, oh, okay, this is giving us even more confirmation that the Federal Reserve will be hiking rates. Why? Because the data is strong, right? The Fed doesn't have to be so worried about raising interest rates. If jobs are there, they're not worried about stopping jobs, right? They're not worried about stopping economic growth. So end of the day, the market could have taken that as a negative quite easily and said, oh, it's more likely now, given the strong report, that the Federal Reserve will hike. Instead, it appears that they kind of took it in their stride. And what that suggests to me is that it was more a relief rally, okay, rather than anything else. Because actually, expectations of hiking have gone up. Okay, that's what's actually happened. So if you look at what happened last week on Friday, I think it was more a relief rally than anything else. And I think because expectations of rates have actually gone up, there's actually more likelihood that it was a temporary rally, okay, what we saw last week. So this move here, so I do think we're going to be, I don't see us, going for the stars anytime soon. We've got the FOMC coming up in March, so I really expect us to kind of go nowhere for a while. And the reason is because I believe that there is a risk that the hike could be 50 basis points, right? I don't think it will be 50 basis points, but I think the market is thinking about it, and that's enough, right? The market prices things in before they happen. It doesn't matter what actually happens. I think there's a lot of expectation, and you can see that here. I think it's around 50-50 now the market is got for a 50 basis point hike. So it's quite a high percentage in the Fed Fund futures that we've got for a hike. We've also got crude oil, right? You must have noticed this. Crude oil going up to multi-year highs now. Right now, again, the market has shrugged that off, right? And it's not really been too concerned about it. But end of the day, the Fed is worried about inflation. If that continues to creep up and we have this going up and rate hikes coming, could be a potential problem. So on the downside, I see risks as 50 basis point hike and oil. What can we do? We just got to observe these things. So coming into next week, that's what I'm going to be doing, observing this very, very closely, watching, what's the market pricing in terms of March? Does that tend to ease? Does it tend to seem to go up next week? We do have some things that can counter some of the downside risks. So earnings, let's have a very quick look. And I think that's another reason maybe the market was quite supported last week, even though the payrolls suggested that the Fed is more likely to hike, which we're seeing in the probabilities of a hike. EPS surprise, very, very strong. On average, 4.7% versus 8.8 in tech. So tech is really the leader at the moment. And off the top of my head, I think it's 78% of the 60% of companies that have reported already have beaten earnings by 4.7% versus historical average of 70% and 5.3%. Okay, so very strong numbers. All right, so 78% are beating earnings. Obviously, historically, 70% tend to do that, so slightly higher than average, by 4.7% versus historical average of 5.3%. So basically, strong earnings, right, continuing to come through. We still got 40% left to report, so got some strong potential upside support coming in next week from earnings. To counter that, I mentioned oil prices and obviously worries about 50 basis point hike still there. So those are the kind of things I suggest that you should be looking at next week, okay? So basically, right, the focus is going to be on inflation, all right? Going into kind of the next week, because obviously we've got CPI coming out. First, look at inflation, but also the focus is going to be on inflation because if you think about it, the Fed doesn't have to worry too much now about growth, okay? It can hike. It's pretty much been given the room to hike because payrolls are up. Obviously, a lot of data has been strong recently, so the Fed doesn't need to worry about choking off economic growth. So everyone is going to be watching the inflation path, okay? And if inflation starts to ease off some of the inflation readings we see, then we may see the market rally because they'll be thinking, oh, the Fed doesn't have to be so aggressive anymore. Whereas if inflation over the next week and oil, and obviously oil impacts inflation, if these things tend to continue to rally, then obviously that could be negative for market. So pretty straightforward, right? So you know what I'm going to be looking at. Hit the button to subscribe. Hopefully that was useful for you. Might not be around next week. We'll see. Have a great week.